Hello, and welcome to this week's edition of the Echo45 Advisors Market and Economic Update. My name is James Sutton, Director of Portfolio Management and Technology, and I'm filling in for John this week. In this video, we'll discuss the evolving role of dividends in today's investment landscape and why they remain important even when yields are near historic lows. As the late Jack Bogle observed, successful investing is about owning businesses and reaping the huge rewards provided by the dividends and earnings growth. This wisdom is particularly relevant today as we navigate a market environment where stocks are near all-time highs while dividend yields sit near historic lows. With Fed rate cuts and an uncertain interest rate environment, understanding how to generate income in today's market becomes even more critical. Let's start by examining how investor attitudes toward dividends have evolved over the past century. For much of the 20th century, dividends were the primary source of equity returns, with yields often exceeding 5 to 7%. Investors bought stocks much like they might buy bonds today, primarily for the income they generated. This began changing as investors shifted focus toward technology driven companies and growth. As the chart shows, today's sector breakdown reflects this evolution. Technology related sectors offer the lowest dividend yields. These sectors include the Magnificent Seven stocks, which generally pay lower dividends or none at all. In contrast, sectors like real estate, energy, and utilities that traditionally focus on income generation offer yields above 3%. This pattern highlights different business strategies that can benefit investors in unique ways. Now, let's look at how interest rates interact with dividend paying stocks. From a company's perspective, profits can be used in two ways: reinvest in the business or return cash to shareholders through dividends. Companies should theoretically return capital when they have sufficient funds for attractive opportunities or when their business model is designed to generate shareholder income. However, dividends serve a broader purpose beyond just providing income. Many corporations pay steady dividends to attract investors and signal financial stability. So, dividend growth often indicates that a company is healthy and that management is confident in future earnings. Interest rates significantly also affect the attractiveness of dividend paying stocks. The 10-year Treasury yield has been well above the dividend yield of the S&P 500 for some time now. But this is uncertain as the Fed cuts rates and interest rates fluctuate. This earnings yield chart shows how attractive stocks are compared to treasuries. The downward trend in recent years results from stocks climbing to new highs amid higher interest rates. However, this trend is also stabilized this year. Finally, let's examine why dividends remain an important consideration for investors. According to Standard & Poor's, dividends have contributed 31% of the total return for the S&P 500 since 1926, while capital appreciation contributed 69%. This chart demonstrates that $1 invested in stocks in 1926 grew to approximately $18,000 by 2025, showing the power of compound growth over long periods. This growth came from both dividends and capital appreciation, though the specific mix varied significantly across different decades. What remained constant was the importance of staying invested through various market cycles. We hope you found these insights helpful. If you'd like to learn more about dividend strategies or portfolio income planning, don't hesitate to reach out to us. We look forward to speaking with you soon. Have a great week.